In today's video, I am going to be breaking down my top 5 picks for amazing stocks and dividend stocks in the year 2022. So let's get down, let's check these out, and some just might surprise you. So the first stock, we're going to start in the United States on the American market, and then, of course, we're going to be moving up here to Canada. But first, Taiwan Semiconductor Manufacturing Company Limited, a TSM is the ticker. I personally feel this is a fantastic company for dividends, even though it only pays right now 1.58%. That's not a heck of a lot. However, the volume is definitely there, and the PE ratio versus other chip makers is not that bad. It has recently had a massive growth between the last, basically, half of 2020, and it's kind of stabilized and gone pretty much sideways ever since 2021 started. We're going to ignore that little spike there. Now, it does pay a quarterly dividend, and recently the dividend's been lower than it was earlier on a couple of years ago. Now, why is that? Well, first off, they were having fantastic earnings back then. They still are. They're still beating earnings estimates every single quarter. But this is why right here I think that they could potentially raise their dividend again to the points of what we see in 2018, 2019. But then again, you have to also remember that these were yearly dividends in some cases versus quarterly dividends now. So if you go up and you compare June over June, there is actually an increase. So you have to keep that in mind when you're looking at historical dividends. Companies do change how they make dividends, and when you start seeing the price of their revenue and earnings coming in at where it is, we can definitely see an uptrend and a potential upswing in their dividend as well. Whenever companies that pay dividends make more earnings, they generally raise their dividend. Texas Instruments is another one from the United States. TXN is the ticker symbol, and what we're getting here is, again, still a technically low dividend of 2.4%. But look at the volume for one, 4.4 million shares. The PE ratio is actually lower than Taiwan Semiconductor. And the growth is also kind of stabilized as well. But if we look at this history, $75 to basically $200 today, that is a massive growth over 5 years. And then if we look at the MACD, we can see that there may be still some downward pressure for a very slight period of time. However, look at where the MACD was there versus here. If it came down just a little bit more, there could be some massive growth coming throughout maybe the middle or last half of this year, or 2022, I should say. But this is why it's such an amazing dividend stock. It's not the fact that it's only paying 2.5%. It's the fact that since 2017, they have almost doubled their dividend in a 4.5-ish year period. If we go back even farther and we look at actually roughly 5 years, that would technically be the November dividend of 2016. That's 50 cents all the way up to now being $1.15 per share. You basically can look at that as saying in 5 years, in theory, your 2.5% dividend would then turn into a basically 5% dividend, and you'll probably be up 2, 3, or even 4 times what you originally invested. Now, of course, whatever happens in the past is no guarantee on what happens into the future. However, when we're looking at least chips, there's going to be more and more need for chips into the future. And then we can look at the financials, and their revenue has been slightly decreasing. There's been chip shortages. It's harder to get chips made. That's what I've been reading. However, their earnings are still up. They are beating their quarterly estimates. This is still a very strong stock. Going to Canada now, TransAlta Renewables, I think, is going to have a fantastic 2022. We have to remember that there's more and more governments who are looking to spend more and more money on renewable resources. Things like solar, things like wind power. Those two power generation options are fantastic, and they're going to be growing into the future. That's kind of why I think Tesla is going to be doing really well over the next 5 to 10 years as well, but that company didn't make my list. But TransAlta, they pay a dividend, and they are basically a power generation company without really worrying about nuclear or anything. They're just 100% renewables. They pay almost 5%. Their average volume is 460,000 shares traded on average every single day. Their 5-year chart is actually not that bad, and it's had a little bit of a pullback. And if we really want to zoom in, we can see that they haven't had exactly that great of a time. It's currently below that double bottom there, so it's not looking all that great. However, when we start looking at things like the MACD, it looks like it could be potentially starting to turn. So that, if that converges or the blue line goes over that green line, I'm colorblind, it could be something different, but either way, you get the point. If that blue line goes over top of the green, there's going to be at least some kind of growth very soon. Another fantastic thing I like about TransAlta is the fact that it pays a monthly dividend. Monthly. If you are looking for an income replacement, let's say you're retired or you're trying to have something that will allow you to be able to not worry about whatever money is coming in every single month. Let's say you run your own business. This could really stabilize your life. Their revenue doesn't necessarily change all that much every year. The last couple of years it's come down slightly. Their earnings have also come down slightly as well. However, they are also missing their quarterly earnings. But you can't really deny the fact that their stock price is doing pretty well, and their dividend hasn't really changed all that much. Like, literally all that much at all. Like, they last changed it back 2017, 2018, and at that point, they raised it from 73 to 78 cents. Now, if you're looking for dividend growth, this is not the stock for you. Enbridge is another fantastic option. The reason why I would be looking at Enbridge is not for the oil transportation. Even though oil transportation is still a massive, massive part of Enbridge's game, what we're really looking at, or at least what I'm really looking at, is their renewables resources, their renewables portfolio, where they have wind and solar. And I think that that could be a massive growth into the future for Enbridge. They pay a massive dividend as well, but if they can continue to invest in renewable resources like they have been in the past, this could be a very, very viable option going out 10, 15, even 20 years. And like I was mentioning, 7.06% dividend, average volume of 9 million shares traded per day. This is a very highly traded stock. Their PE ratio is 17, and if you wanted to compare it to TransAlta, it is actually cheaper as well than TransAlta, so that's kind of an option. Enbridge's stock price, however, is not like TransAlta and has kind of dipped from where it has been 5 years ago, and it seems to always go for a little bit of a run, and then it seems to pull back. We've seen this over and over and over again, and I would definitely be buying on pullbacks if I was looking for high dividend and high potential into the future. It's a solid company. It is what they would classify as a blue chip stock. It's a strong company. And also they do raise their dividends quite frequently. Generally once a year they raise their dividend. Now this past one hasn't been a massive gain. However, the one previous was a pretty strong gain. So even though you're paying or getting paid a 7% and you've got a stock price that's essentially, technically speaking, going sideways, then at least with dividend growth, it's fantastic into the future. They're doing okay. They did have one miss, and they did have lower revenue and earnings in 2020, so keep that in mind. But pre-pandemic and, of course, prior years, we do see an uptick in both revenue and earnings, which is fantastic. And then, of course, the Canadian banks. I've said this a few times before. I've got a love affair with Canadian banks. Right now, they have just raised their dividend massively. Some were as low as a 10% raise. Some were as high as 25% like BMO. And we're looking at a $5.32 per share dividend every single year, so around 4% at this point, and a volume of 2 million shares, and of course a PE ratio that is kind of on the high end as to where I like to buy Canadian banks. I like to try and buy them under 11 PE, or even, if preferably, under 10, but it is a bit expensive now, but it's still very strong. They just made that huge purchase of a US bank, so keep that in mind. They did trade sideways before the pandemic. We then learned right about there that the Canadian banks can do extremely well during hard times, and they've kind of exploded since then. Now, if there's ever a pullback in housing prices, I don't know how that will affect the banks. In history, it's affected them pretty badly. However, housing prices have gone through the roof, and they need to come down. We don't see the dividend increase come up just as of yet. That's coming very, very soon. However, it is coming. We can see that they're beating earnings, like I was mentioning. They had a fantastic 2021 revenue, earnings-wise. This is why everyone just wants to buy the Canadian banks, because they are making money when nobody else is. And when that happens, their stock price goes up. And pretty much any Canadian bank you can buy. BMO just seems to be one of the better, or at least stronger ones right now, in my own personal opinion. But I always like to try and aim for the ones with the lower PE ratio. But when it comes to BMO raising their dividend by 25% and having the largest purchase of a US bank as well, those two things really bode well for BMO in my own personal eyes. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.